Good morning, everybody, and welcome to the fourth quarter Roundup with Nedgroup Investments. My name is David Levinson, and I have the pleasure of hosting you for the next couple of hours this morning, which will be a whirlwind across economic, geopolitical, and financial markets with our best-of-breed partner managers across the full spectrum of asset classes, from fixed income all the way to full equity. So we hope you find this morning's session very enlightening. When I was trying to reflect on how we describe the last year, there's a famous quote by Mario Andretti saying that if everything seems under control, you're not going fast enough. And the news has most certainly been coming thick and very, very fast. So we're gripping the wheel tightly to get that sense of control. And hopefully after today, you yourselves will have a better sense of control as well as we look to negate 2026. What we've had recently in terms of news headlines, a autocratic leader was kidnapped in the middle of the night. Ships carrying oil have also been intercepted on their way across our international waters. We've had ICE agents making headlines for the wrong reasons. Gaza border peace has been pieced together. Iranian sort of social uprising in another autocratic region there. And just recently, gold has hit $5,000, and that's just in the last 3 weeks. So certainly keeping us on our toes. And the first person we're going to check if he is on his toes, and he most certainly always is David Roberts. David, as always, thanks for joining us this morning.
No problem. Good to speak to you, David.
And as a reminder to the viewers, so David Roberts is the portfolio manager on our Global Strategic Bond Fund. So David, before we get into some of the interesting meat and potatoes, let's just recap a little bit about what happened in the fourth quarter, how the fund performed, and some of the drivers behind that.
Yeah, thanks, David. I mean, it's an interesting one. As you see, there's such, in some ways you could see the world almost feels as if it's on fire. There's so much stuff happening. And we'll come on and look maybe in a minute or two at how actually in bond markets the volatility is reduced, which is quite strange. But we focus a little bit just then on that fourth quarter. Our total return was about 1%, so that was a little bit ahead of the global index. The interesting thing for us was that 1% was primarily composed of just the income on the portfolio. So that's almost normal. That's what you expect. That's suggestive that things have been quite dull and boring, which, as you say, has not been the case if you just read headlines. So the majority of that 1% return coming from the income, the yield on the portfolio, a little bit in excess of the global market. Possibly the main driver for that is that we tend to run with what we would call a positive carry trade. So that means in bond land, we have a higher number of investment grade bonds or corporate bonds in general than the global bond market index. So we have a preference, a bias, a long-term skew in that direction. And they continue to do us nicely. And as I say, in addition to just the income, the yield on the portfolio, we added some extra value through that, David. So that really built on the previous 3 quarters and left us nicely placed. I would say, just in summary of the performance, that the global market returning a little bit over 4%, that's not too far off what we expect the average of bond markets to be, indeed, this coming year and for the next decade. But fortunately, against that backdrop, we were able to add 2 or 3% extra.
Thank you, David. Yeah, I remember in my investment banking days, the epitome of a carry trade would be borrowing from the Japanese government at near zero rates and investing it anywhere else in the world, and you get sort of 400 basis points.
That's still, we maybe come on and talk about that, David, as we sit here at the end of January and discuss what's happened. One of the big things in markets at the moment is whether or not that yen trade, that carry trade, is unwinding. As I say, to be clear, ours is very, very different. What we are really talking about is substituting, in some cases, highly indebted government bonds for perhaps less indebted and arguably more stable, high-quality corporate bonds. So it's a slightly different thing, but what it does hopefully do is generate a little more income for investors than would otherwise be the case.
Okay, thank you very much for that insight. I was relatively layman in my explanation there, but your next slide, David, speaks to volatility on US Treasuries. I think you're looking at the 10-year US Treasury there, and typically volatility offers some sense of opportunity, but the volatility seems to have settled a little bit in the fourth quarter last year. So maybe you can speak to how that might have shifted and affected the fund.
Yeah, I mean, it's quite remarkable, to be honest, as you say, David. And I think what we maybe just step back slightly and there's so much going on in the world that's best described as geopolitical rather than economic. And my experience over the last 30 years is that generally economics in the medium to long term wins out over politics. I mean, the classic, I guess, would have been Liberation Day last year. So the beginning of the second quarter last year, we saw this huge volatility in markets, and then even the mighty President of the United States had to realise that the damage that was being done to wealth, particularly with a near 15% plunge in core US equity markets, that damage had to be addressed in the short term, and hence we had some of the rolling back of initial tariffs. But certainly what we've seen, I think, is that a move in most asset classes, certainly in fixed income, towards probably fair value, we would say. So you mentioned Japan earlier, and everyone's getting a bit excited as Japanese yields move higher and higher and higher with every day that passes. But if we think about the rest of the G10, really, most yields had already moved higher. So we'd had that big fiscal expansion with COVID, and then post that we saw inflation rise, and then since then it's been a case of bond yields rising to meet that, except in Japan. So when we started the year, we had US Treasury yields probably at a little bit too high a level, and we've seen that generally trend down. But as we moved more towards where we think fair value is, around about 4%, so too we've seen volatility just come out of the market a little bit. So as you say, the real opportunity just to play the trend, the theme of yields, it has dissipated a bit. So what it means for us really is that we need to have a look around and see if there are other opportunities in core markets rather than risk everything just betting on the trend, the direction in US Treasuries. And thankfully, as we'll see in a minute or two, I think there are one or two good opportunities still about.
Yeah, well, we can bring forward a minute or two and shoot right there now, because the next slide, the devil and opportunity are often in the detail. You showcase the German government yield curve, I think the differential between the 30 and the 5-year. So with few opportunities, I guess, in that US Treasury space, how does having access to these, global universe of high quality bonds, I guess that opportunity set, how does it prevent yourself without really taking on unnecessary risk at the same time?
Yeah. So what we know, David, if we look back over 30 or 50 years, is that normally most core bond markets, so investment grade and corporate bonds, follow repeat patterns. So we talk about mean reverting. So there's a caveat. So what that means is if they look expensive, they normally become cheaper. If they look cheap, they normally become expensive. But importantly, the relationship between them quite often moves out of sync. And we can exploit those differences by owning one part of the market, not owning another part of the market, and benefiting from that. So what we had, the chart, I mean, it's quite noisy, but what the chart, all you need to think about on that chart on the slide is that there are times when the relationship peaks and troughs, and you don't really need to, it's up to me to worry about why that is. But all it does is to show to investors that those opportunities do exist. And all we're looking at there is the relationship between German and American bonds in different parts of the market. So even concentrating on the G3 effectively, there are still opportunities within those high quality parts of the market to make extra return for investors if we get it right. And no need really to chase some of the more illiquid parts of the market. And again, we'll see that as we move through the presentation.
Okay, great. Thank you, David. I was quite excited when I saw your next slide, because I imagine a lot of the conversation today is going to be revolved around AI, particularly with our equity managers. But for this to rear its head in a fixed income strategy is interesting, because I don't think we often draw that connection between what's happening in the equity market and then the debt space as well. So maybe talk us through a little bit about AI investment, how it's accelerating globally, and what does that mean in that fixed income space?
Yeah, so I think it's probably, I think your point is very, very well made. So AI is seen as something that's going to create efficiency and potentially, again, general wealth for well, maybe for certain individuals, but hopefully that will be spread. The benefits will be seen for decades and be seen by everyone. That's tended to be an equity story. And if you move away from the MAG 7 so into the small to mid cap, and I'm sure other managers will talk about that, there are huge opportunities for companies to ride the coattails of this massive wave of investment. The investment so far has focused or has been primarily through equity raising. So very few companies, certainly, even at the top end, have come to the bond market seeking finance for AI projects. They've really been focused on what we would describe as asset-backed. So they've been where there is some, as a bondholder, you lend to an entity, but you have the rights over their assets. And that's been prevalent in the data center build-out. So we've seen quite a lot of that. But in terms of what we would call mainstream companies, it's been less prevalent. But late last year, we saw Oracle, US company, come to the market with a huge bond offering, multi-billion bond offering, seeking to raise finance to allow them to develop their AI franchise effectively. That seemed fine, and the pattern of AI returns for most investors, certainly in equity land, had been quite positive. But we saw this jumbo deal, and what it really meant for Oracle or for investors in Oracle was risk. So Oracle wrote a whole pile of debt to raise money to invest in AI projects with no certainty of outcome. Now, whilst the equity market is the kind of place you should go if you're unsure, but you think you have a chance of making money, in bond land, generally what you want is a higher degree of certainty. So that balance sheet destruction, that huge pile of debt that Oracle wrote, initially was quite well received, but then when investors really started to think about it, they realized that that meant potential value destruction, the company being more risky and more prone to default. And that's the killer word in bonds, is default, as we know. So what happened very quickly thereafter then is the price of Oracle bonds started to fall. And as we see when we ran this chart a couple of weeks ago, Oracle debt had fallen about, well, more than 10% in price. So for that type of high quality entity to see that level of destruction, of value destruction in the short term, albeit so far just mark to market, is a warning sign for bond investors of what may be to come. Just to extend that slightly, there are projections of material supply into corporate bond land in 2026 from similar entities to Oracle and then for AI and infrastructure more generally. How that plays out is going to be very interesting. What bond investors have a habit of doing is being able to ring fence certain sectors. And over the past decade, we've seen problems in the energy sector, in the auto sector, and then maybe last year more in the chemical sector. And it's not spread into bond yields more generally. So if we do see a wave of AI financing, as many are predicting, the best guess at the moment is it's likely to see potential opportunity, but also some value destruction in companies that are more tech orientated who have debt outstanding today. So in terms of what we're looking at, although Oracle's price, bond prices have fallen, we do expect more supply of that nature. And so in our portfolio, we're still avoiding pretty much anything that's AI related, not because it's necessarily a bad overall investment, but it's generally stuff that we see as more suited to our equity colleagues rather than bond investors.
So just looking at that chart on the left, I mean, 12% destruction, is that it's quite eye-opening. Is that common? I mean, I imagine it's a AAA investment graded bond. Is this something you see much in the? No,
in mega caps, to see bond prices move. Again, this is also at a time when, as we saw from that earlier chart, US Treasuries have been quite stable. So the yield or the spread of these bonds, which is the left-hand chart, is relative to US Treasuries. So the yield that you're getting relative to Treasuries has increased significantly. And because the price of US Treasuries didn't really change, that means there's been this mark-to-market value destruction. But that is highly, highly unusual. Normally in an investment grade company, that type of underperformance is a sign of material stress. Now, just to be clear, the probability of default in Oracle has increased. That is what this is saying. That is self-inflicted. Oracle have made that decision that they want to weaken the quality of their balance sheet to increase their leverage because they believe there are opportunities in AI that will benefit their shareholders in years to come. But to take advantage of that opportunity, they are taking more risk. And as I say, from our perspective, that's one risk we just currently are not prepared to take.
Yeah, I imagine so. And I imagine the credit default market is probably reacting in kind to the bond market share as well in terms of protecting that. And,
yeah,
and I see,
you're definitely right, David.
Yeah, maybe a loose link to Larry Ellison. I see that he's might be failing in his bid with Paramount and Warner Brothers to Netflix, but that's a discussion for another day.
It's a good point though, David, because a lot of these things, like if the equity market, normally some of these, let's call them more speculative opportunities, are primarily equity funded, and there's a huge thriving private market at the moment, as we know. But what we've seen in recent weeks really is a little bit of concern around both private equity and private debt. And I'm sure maybe some of the other managers will talk about it. But if that concern starts to spread, what it means for the primary market is some of those more opportunistic deals might not be funded in the private market and then have to come and try and find a home in the public market. And if that starts to happen, then again, there could be some decent opportunities, but investors will need to be very careful that they're not taking on too much risk simply because another market doesn't want to invest in it.
Okay, thanks, Dave. Well, on that notion of opportunities and risk, the next slide speaks to the summary from Q4. I imagine you've covered a few of those points, and then probably my favorite section of today would be your outlook for the year ahead. Last time we chatted, it was in the throes of the Ashes series, so I see you have some more comments here on Australia. So as you take a little sip of your coffee there. Yeah, so maybe let's see your views on the year ahead. I feel like we've already lived a year in the last 3 weeks.
Yeah, I mean, and yet returns in global bonds for the beginning of 2026 are quite flat. We did see prices move a little bit higher initially, but then particularly the global bond market's largely driven by the G7, and some of the concerns that we've had, I think, as citizens, never mind investors, around places like, as you say, whether they're duly elected or not, but people in certain countries being removed by force, threats of invasion, goodness only knows what not. That normally is seen as quite a positive sign for bonds, so geopolitical risk increases flight to quality. We've not really seen that, and it's almost been the opposite. And part of that, I think, has been because some investors clearly have worries about the direction of travel for US economics, aligned with politics. So to fund some of the US expansionist theory might require quite a lot of additional debt. So there's a lot of uncertainty, and it's, as we've seen, as everyone will have read, and you mentioned in your introduction, that's flowing through to precious metals to a greater extent than it is to the bond market. So yeah, I mean, 2026, I think, is, maybe for some of the wrong reasons, but it's likely to be a fascinating year. So in those core markets, so the biggest bond markets in the world, the US, Japan, and Germany, with the EU rather than Germany specifically, we've seen some of the volatility come down. Japan is actually moving in the opposite direction at the moment, but that it really is because the bond market is still politicized. So people think the Bank of Japan is just going to follow the government as they look to write more debt and become more political. So in terms of what we're doing in our portfolio, we've started to buy some Japanese debt, as I think we said in the previous commentary, but we're still less than half weighted to the global index. Some long-dated Japanese bonds we think offer really good long-term value, but it's, there's an old saying in the market about when's the best time to catch a falling knife, to which the answer is after it's landed on the ground. And Japan is still in the process of, Japanese bonds are still in the process of falling. So we'll take our time with that one. But all what this is doing is it's seeing an increasing sort of spread of performance amongst different bond markets, and we think that's likely to continue. And I have a chart of Australia, or Australian bond yields rather, on the slide here. And what that shows is that in the space of a couple of months, somewhere like Australia has moved from an expectation of rate cuts to expecting rate hikes. Now that's unusual to move in such a short space of time. That chart shows how yields on Australian bonds have blown out. So there's a warning signal there, I think, for certainly a lot of the developed world, that the bond market can turn very, very quickly if they feel that there are reasons not to own securities. From our perspective, again, that should be opportunity. We were actually short Australia, and we've now moved to a long bond position. So if you owned it, bad news. But the good news is there are lots of opportunities, things being thrown up that we think can continue to make a little bit of excess return for investors, even if that core part of the market, the volatility in somewhere like America or Germany, has started to come down. Other parts of the market that are well developed, highly liquid, like Australia, like Canada, arguably like the United Kingdom as well, where we're seeing opportunities created, again, in part by politics, bond market pricing not justifying economics. And so, as I say, as a result, David, perhaps we might have to work a little bit harder. We might not get those easy directional wins. The overall level of yields we think is still really nice for investors, should generate good, strong, positive income. And then hopefully we can find opportunities elsewhere in the market, take advantage of some of the geopolitics, and allow economics to play out and make some money for our clients.
I think that could be my key takeaway from today, that dance taking place between geopolitics and fundamental economics. But I mean, anecdotally, just looking at some of those bullets there, I recall Australia, I think, were the first country to increase rates from the global financial crisis, as that unwind was happening there as well. They also famously didn't experience a recession forever, I think, until the COVID years. And then on the geopolitical side of Japan anyway, I see, I don't know if their relationship with China is souring. I see they returned a couple of panda bears to China just last week. So we'll keep our eye on those developments as they take place. But maybe, David, in the interest of time, your ultimate slide here, I think, is really the nuts and bolts for investors in the fund to think about and to take home after today's session. And maybe you want to draw a couple of conclusions from this slide that might underpin these positions that you've spoken about.
Yeah, so again, our focus is on core bond markets, G7, G10, high quality, so mainly government and investment grade. So looking at the one on the left first, so valuation, slightly cheap. So we've been more than compensated for both inflation today and likely inflation. That's a good position to be in, a positive real return if nothing happens. Fundamentals, so we talk about economics, they've been fine. No real threat to that, and really, again, the market in the short term is focusing on geopolitics. Technicals, we really mean the interaction between supply and demand. Tons of supply coming. Again, it probably as much in corporate bonds, look at that in a second, as there is in sovereigns. So there is real opportunity in the rates market, but our best guess is very little happens, and the total return on a G7, G10 is inflation plus 1 or 2% over the course of 2026. Dull, boring, old normal, but still there's plenty of opportunity. Corporate bonds, I think, for us is the interesting one. In some measures, very expensive. So we still own a fair weight, about 60% of our portfolio in corporate bonds. That's less than we would have on average, but also we are heavily skewed to shorter maturity and better quality. It's more likely that any weakness would come from geopolitics, because economic fundamentals for companies are very good, nice levels of growth, strong balance sheets. But if we did see a problem in volatility created by geopolitics, our intention would be to add quite significantly to our corporate bond exposure. Say our raw weighting 60%, but that's hiding the fact that it's short dated and high quality. So just if it was to summarise in one sentence, core bonds we think still offer nice opportunity, high level of income. Now's not the time to take a huge amount of risk, but we do think there's going to be great opportunities, partly created by geopolitics, as we move through the quarter, David.
I think we got the gist of that, David, but maybe it's just a parting question before we let you go is maybe two questions actually on that geopolitical side. As the independence of the Fed and Jay Powell gets challenged, do these events have a way of filtering down to corporate debt, not just national debt as well? And on the back of those tariffs, your comment there in the third column around CPI in the market could be disappointed if it doesn't fall. Do you think there's still some stickiness in CPI that we can expect?
Yeah, I think there's quite a bit of stickiness in CPI, David, and again, the lessons that we've seen from the last couple of years is that anything tariff related, certainly at the margin, is pro-inflationary, so boosts inflation. I'd say today, again, end of January, and this can change, within the space of minutes. The market is definitely of the opinion that Trump is, again, there's a phrase that the English use, all mouth and no trousers. So he shouts, or a dog that barks a lot but doesn't really bite. And that's been interpreted as this taco trade. Trump always chickens out. And arguably, we've seen that in the latest stuff with Greenland. So it's quite difficult. But markets, I would say, compared with April last year, are now much more sanguine. So they're not reacting as egregiously as they had maybe a year ago, and potentially that is a mistake. So they're under anticipating what could happen. So again, from our perspective, I think the key thing at the moment is there's a high degree of uncertainty. Markets are quite calm. Volatility has come down, but that's not necessarily because everything is great. It's more that people are anticipating things to be good. And that's always quite a dangerous situation to be in. So a higher degree of complacency today. Again, in our portfolios, as I mentioned earlier, we do see lots of opportunity, but also we don't think now is the time just to wade in. And we're not in a casino. It's not shove it all into black or red. We can afford to wait and just see how some of these themes play out over the course of the next few weeks. And if they create significant volatility, price destruction in certain areas, or indeed if some of the things we own go up a lot, that just gives us an opportunity to rotate.
Okay, wonderful. Thank you, David. I have two dogs, one that barks and doesn't bite, and one that bites and doesn't bark. But I'm happy that you referred to Donald Trump in the former. I think that's a little bit of a softer landing for markets. But yeah, thanks again for your time today. Thanks for what looks a really good performance from the fund perspective, and keep it up for the remainder of the year. I think investors realize and get a better sense after today's discussion how the fund is positioned going forward. So thank you very much again.
Thank you to David, and thank you to everyone who invests with us.
Cheers. Take care.